Now, here are your hosts, Dominick and Michael.
All right, I'm Michael Hartzman. Today is Tuesday, April 18th, 2023. And after a 2-week break, I'm back with my partner, Dominick. How are you, Dom?
Doing great, Mike, and happy to be back home.
Happy to be back home. By your background, I guess we're calling Long Island home this week.
For a week or so.
Well, welcome back to Long Island.
Thanks.
So I would best describe the last 2 weeks as no news is good news. As we talked about this morning on our broker call, seems like the market's a little bit in a cruise control, kind of trading in a holding pattern. And I don't know if that's necessarily a bad thing. I think it could be a good thing.
Look, considering what we've gone through in the last month, Mike, is with a specific focus on the banking crisis that went through. We had some pretty large banks fail with the FDIC and the Fed taking over. That was scary stuff. That was scary stuff for the markets. That was very scary stuff for clients. And to be back to pretty close to the year-to-date highs, that says a lot about how resilient this market has been, at least up to this point.
So we did a show two days after the Fed stepped in on that Sunday night, and we said then that we thought the Fed being proactive and really reassuring and backstopping all deposits, right? Not just from those 2 or 3 banks, backstopping all deposits just kind of took the wind out of the anxiety that story could have truly created for a lot of legitimate reasons.
And look, grateful for that, right, Mike? But we touched on it. Really, when you talk about these runs on banks, it's really about your belief and your faith. And if that gets challenged, and it creates a cascade, it creates the snowball that just keeps getting larger and larger as it rolls downhill. And so I think they did a good job. I do want to give credit to both the FDIC and the Fed stepping up to the plate and really taking that risk off the table. And I think that calmed not only depositors in the banks, but investors. I think it did a good job of at least putting a little water on that fire.
Oh, yeah. There's no doubt, Dom, that a story like that could literally become a self-fulfilling prophecy.
Yeah, that could have gone bad, really bad.
Really bad. Look, we both lived through it, and all of our clients lived through 2008, right? And we don't have to rehash it tonight, but this was not that, right? This was, hopefully we all learned from our mistakes, and this was squashed very early on in the process.
And to that point, Mike, we're starting to get bank earnings for this quarter. Mm-hmm. And so far, so good. Now the larger banks have reported in weeks. They're very well capitalized. They're good money centers. Their profits were pretty good. So we're starting to get some reaffirmation that, hey, maybe that picture is not anywhere near as bad as some people had thought.
Exactly. And talking about the market in general, just to reiterate what you said, through Friday, the S&P is up 8.31%. The Dow, which is, a lot of the old classic stalwarts, that's only up 2.84. And the NASDAQ, which got clobbered last year, down 30 last year, through the first quarter and 2 weeks, the NASDAQ's up over 16%, Dom, which is a really very healthy comeback. And what's really interesting, on a year-over-year basis, the S&P is only down 4, the Dow is flat, and the NASDAQ's only down 8. So which means, the market really sold off in the first half of last year. And a lot of those numbers now on a revolving 1-year basis are starting to roll off.
Yeah, if we're looking at the 12-month backwards period, that first quarter of last year was pretty horrible. Now falls off the page, right? But focusing on today, and if we want, a lot of people do like to look at the S&P 500. It's really been that same 10 plus minus stocks the big, large cap growth stocks, the ones that you just brought up that really got hurt last year, they've recovered a lot this year, and they're kind of bringing up the bottom. If you focus on, and you mentioned the Dow, the value stocks, the more boring, economically tied companies, they're actually about flat for the year. You probably would have made, you maybe might be up 1% or so. So it's really been these large cap growth stocks that have driven the bus so far.
And what's also interesting to me as we dig down into the sectors. So as you just brought up, consumer communication services were up 24, technology's up 20. And we kind of talked about that, and we're not surprised by that.
Two of the worst performing sectors last year.
Exactly. But what's a little surprising to me, if, and it's a big if, we do have a recession, consumer discretion, Dom, is up 14%. Right? So discretion means it's things people are buying that they don't necessarily have to buy, but might want to buy. And I was really surprised to see how well that sector has done year to date. And what do you think, if we do have a recession, how that sector would be impacted?
Well, normally that's a sector that really, really does get beat up, right? Because if the consumer has the choice of buying something or not buying something, then clearly in a recessionary environment, they're not going to buy, right? Where the staples, which you bring up all the time, the consumer's going to buy the food, they're going to buy the basic products they need to live on. When we focus on the discretionary, that area is dominated by companies like Amazon and Nike, and so Tesla's in that index as well. So I think some of these larger cap growth stocks have influenced the index itself, particularly Tesla, which is up an extraordinary amount this year. So again, just looking at it as an index, that might be a little bit misleading, but it does show overall the strength of the consumer, which I think is what's been holding up not only the economy, but this market so far.
I feel like the consumer has been holding up the market for decades. I feel like this is a never-ending story.
Look, we need the consumer, as we said many times on this show. The consumer represents close to 70% of the economy. So if the consumer stops spending, we really, really have a problem. And I think at the end, Mike, that's maybe why, if we did get a recession, which is what the Fed is calling for, a mild recession, then maybe it's not going to be so bad, right? Because at the end of the day, the consumer will pull back on spending. I don't know if the American consumer can actually stop. I don't know if it's in their DNA longer.
Probably not. Dom, we're doing a show tonight that you and I have been trying to do for a very, very long time. And that's life insurance, and life insurance with long-term care, life insurance in general, how it ties into estate planning, how it ties into wealth preservation. And tonight we have a friend of the show, a gentleman named Howard Jonas, who's a director of advanced sales at Crump. As you know, you and I do a lot of work with Crump. They're a great, great resource to us. And Howard is someone we could always easily get on the phone with some of our dumb questions and some of our more advanced questions.
Mine anyway, Mike, mine.
He'll tell you there's no such thing as a dumb question, but he's being polite. But I'm looking forward to our conversation tonight with Howard, because we live in a high tax state, New York State. It kind of has, in my opinion, this stealthy estate tax, and Howard and his company have ways to try and fight that. So I'm really looking forward to his point of view tonight.
Interesting subject, Mike. And ours is a wealth planning firm. So this is a module that fits into everyday discussions, and hopefully we can enlighten some people on what's going on out there.
So we will be right back with Howard Jonas, Director of Advanced Sales at Crump Life Insurance.
Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick Tavella, and our guest this evening, Howard Jonas, COU, CHFC, REBC, and CASL. That's a lot of alphabets, my friend. Director of Advanced Sales at Crump Insurance. Good to see you. Thanks for making the time tonight, Howard.
Thanks for having me. I appreciate it.
Welcome, Howard.
Thank you. Thank you.
So, Howard, let's just jump in to New York State. I think New York State's estate tax rules a little eye-opening. and we had an estate attorney on a few weeks ago and we discussed it. And I think it's great to have you on to follow up on that and discuss some possible solutions. We all know that the federal estate tax is, I think it's over $12 million at this point. But New York State works much differently and it's much lower threshold. And I think it could sneak up on people pretty quickly. So could you just get into that a little bit and then talk about, some of the ways we as financial professionals with your help could come up with some solutions?
Sure. So New York State is kind of an interesting place. You have the state estate tax, which right now currently sits at 6.58 million. That's indexed for inflation. Now with the federal tax, it's 12.9 million. What does this number mean in reality? That means if I'm a single person and I'm worth 12.9 million, I die today, there's no federal estate tax on any asset I pass to anyone I want. New York, 6.58. Now, if a married couple has double 12.9, but not in New York, it's 6.58. So what does this mean? If you live in New York and you're worth less than 6.58 million, no state estate tax to Albany, nothing, you're free and clear. However, if you're worth up to 6.9 million, now you might have an issue. If you're actually worth 6.9 million, you look at that delta between 6.58 and 6.9, you're going to pay a tax just on that difference. But once your estate exceeds 6.9 million, now all of it's taxable. And the tax rate starts at about 3% and goes all the way up to 16%. Essentially, if you're worth in excess of $10 million, you're going to owe New York State roughly 16% of your estate. So it's a significant number, 16%, without a doubt. So what do we do with clients who are worth X amount of dollars and realize, boy, when I'm called to eternity, the feds and New York State is going to take a piece of everything I've worked for? I really have a basic question that I like to ask clients. When you pass away, what do you want to see happen to your stuff? And then I kind of listen. I kind of write down whatever they're saying. Sometimes they say, what do you mean by my stuff? I said, well, if you say to me, Howard, I have a couple of assets that I've had in my family bloodline for decades and generations. Tell me what I need to do to make sure there's enough money or liquidity in my estate to cover the transfer tax so my kids or grandkids don't have to sell that house somewhere. Okay. Or if you say, Howard, I don't want anything to happen to my stuff. Tell me what the transfer tax is going to cost. How can we cover that? And some people say, I don't care what happens to my stuff. My kids are going to get more than what I got. So it kind of depends on what assets the client has and really what they want to see transpire. And then I always remind them, some assets are better than others to transfer to the next generation. Probably the worst asset to have is qualified money. Qualified money is great, 401k, 403b, IRA money, because you get a tax deduction going in. So it reduces your taxable income on the front end, but the government's just sitting there waiting around until you die. And then they're going to take what's called IRD, income in respect of a decedent. And if you live in New York, Albany's going to take some of that. And if you're worth $8, $9, $10 million, you essentially could have federal IRD tax. You could have New York IRD tax, New York state estate tax. And if you die past 2026, when the federal exemption goes down to 6 million, you could have 4 taxes impacting that qualified account. So roughly 75% of your qualified account that you've worked very hard for decades could be wiped out. So this is an asset in the estate planning world we try to attack first to see what happens when people are going to pass away. And sometimes we actually look at using those qualified dollars to not only cover transfer tax, but maybe add a second benefit, sometimes a long-term care benefit. So it depends on the age, of course, the health status of the client, how much is in their 401k or IRA, and really what they're looking to do. What percent of the estate is comprised of those qualified assets?
So Howard, there was a lot for us to digest and for clients to digest. So let's break it down a little bit and into different modules. And as Mike mentioned, we've had an estate attorney visit with us in one of our past podcasts, and we talked about death taxes, which is basically what estate taxes are. And it sounds, I get this from clients all the time. It sounds like, well, that's a big number, Dom. It's really not going to affect me. But, you know, when you think about it, for most people, maybe they own a business and there's a value of that business. Maybe they've made some investment real estate. They own an apartment building or a mixed use building. You mentioned a retirement account. It's not unusual for our clients to have a couple of $1 million. I mean, it's not that impossible to get to this $6+ million number. So I'm going to guess that you get to see that a lot.
Yeah, it's not as difficult as people think. And sometimes people will actually artificially increase their taxable estate without even knowing it. So unfortunately, my life has been life insurance for decades now. And one great thing about life insurance is the death benefit is usually paid out income tax free. However, if you're the owner of your policy and you pass away, while the death benefit is income tax free, the death benefit, the amount is included in your taxable estate. So sometimes I have estate planning cases with clients and I call them fence clients because they're kind of on the estate planning, on the estate fence, not sure if they're going to be eligible or not eligible, or the estate tax is going to impact them. So today you're worth 12.9 million, you're free and clear. However, if you own a life insurance policy for $2.5 million, you pass away, you've just bumped up your taxable estate by $2.5 million. So you are correct.
You're bringing up a really important point in that it's not just an issue of covering this potential cost by buying a life insurance policy, but how it's owned and who owns it can really make a bad situation much worse.
Absolutely. Ownership is everything in my world. And unfortunately, when you're doing what I'm doing for decades, you think about bad things and worse things that can happen. So many times people will say, well, maybe I'll own it, I'll roll the dice, maybe my kids will own it. We're huge fans of using trusts. Trusts allow people to, what I like to call, dictate from the grave. You can still have your wishes carried out. Without the use of certain types of trust, you're really rolling the dice. Because as we know, people get into accidents, people have lawsuits, people get divorced. You know, these are all things that you don't really have a do-over for.
So Howard, well, number one, I want to thank you for channeling George Carlin and asking people about their stuff. I think that's fantastic. You do that. But let's get back to the way the estate tax law works in New York. If I'm a small businessman and I own it by myself, not with my wife, and it's worth, I don't know, $6 million, and then I have other stuff, and I buy myself with my 401ks, my life insurance, I get to $9 million, let's say. Are you telling me that my wife does not get an unlimited marital deduction in the state of New York?
She does, but on her passing, then the estate tax in New York would be due.
So in spite of I've exceeded the $6.9 million threshold, that goes into effect on the second death, not on the first death.
Correct.
Okay. I just wanted to be clear on that.
Sure. No, good question. To me, single business owners face a real interesting dilemma because I'll ask some of them sometimes, hey, you're called to eternity next week. Tell me what happens to your business and your spouse. And sometimes I get that knee-jerk answer, well, my spouse is just going to show up tomorrow and run the business. And I'll go, great. How long has your spouse been involved in the business? Well, not really at all. So it's sort of unrealistic to expect a spouse to come in who's never done anything in the business to take over. And I always remind people, death is one of those weird things. Nobody knows how they're going to react until they're faced with that situation. I've seen situations where a spouse wants nothing to do with the business because it reminds them of their previous spouse. They just want to move on. And sometimes I use the F word, meaning fire sale. Sometimes we try to avoid that if at all possible. So I think our job is to really ask very unpleasant but important questions to our clients, because unless you're hanging out in my kitchen, you're not talking about this stuff on a daily basis.
Well, it's a subject matter, Howard, that people just don't like to talk about, right? The idea, I mean, we often tell clients, the average age for a male is 70 something, right? But everybody in their eyes sees, oh, I'm the guy getting past it. Right? Somebody else will be the person that dies first. So it is a sensitive subject. But if we're going to do true wealth planning, it is a subject we need to broach with clients and make sure that the pieces of the puzzle in place. And certainly life insurance is important. We're going to talk about long-term care in a little bit, but that their wills, their trust documents, we want to make sure that all the eggs are properly lined up. And then God bless, live to 100. That'd be great. But it's our job and our responsibility to ask, and I'll call them the dumb questions.
I always find it's sometimes a bit of a challenge to change the mindset. So for instance, I had a call this morning with a couple 66, 64, and they've been running and gunning for decades. They're amassed a wealth well over $50 million. But it's difficult to have them say, okay, I'm worth X amount of dollars. What's my mental pivot to now figure out how to transfer as much wealth as humanly possible to the next generation without impacting my current lifestyle one iota? It's definitely a challenge.
Well, and Mike, I'd love you to jump in on this one. I'm just going to make a comment, but we'll sit down many a client like, well, you're a millionaire, right? And that's just a number on paper. It's just some of these people, I mean, hardworking, blue collar, but they've, as you mentioned, accumulated quite a bit of wealth. It's hard for them even to comprehend what that number really means, right?
Yeah, it's one of those things where so many times I've seen people come from nothing and now they're worth $100 million. And when someone says, well, when you pass away, the government's going to come in and take 40%. And it doesn't seem real. So many times if I'm out working on a case, and I don't like to go in and say, well, you're worth $116 million. Based upon our calculations, you're going to need a life policy for $52 million. Here's the cost every year. It's very shocking. I generally back into things like that to figure out premium tolerance. Like anything else, no matter what you buy, you have to be comfortable with your purchase and you have to live with it every day. So I kind of look at it that way, to me.
So I think what Dominick and I run into a lot as well, and you must see it as much as we do, when we talk about irrevocable trusts and have an honest conversation with a client, when are they willing to give up control of some of these assets? And I think, Howard, it's not about the premium they have to pay to preserve their wealth. It's not about doing the hard planning. It's about giving up control that I think sometimes is the hardest pill to swallow.
That's a great point. And the simple answer is you're exactly right. An irrevocable gift is an irrevocable gift. Now, that being said, there are things sometimes we can do depending on the nature of the assets. So for example, most companies are taxed as S corps. So if I'm dealing with an S corp owner, 100% owner, 60 years old, somewhat transitioning out of the business, but still wants to call the shots, we might do something called a recapitalization into voting and non-voting S corp shares. Doesn't mess with the S corp itself, but now you still have one class of stock, but now you have voting and non-voting shares. So now the thought is I can gift non-voting shares to my irrevocable trust or sell them or loan them, but because I still control the shares, I still call the shots in the company. If someone has a C corporation, we can set up a family limited partnership or FLP. And sometimes we do a 98-2 split. We'll do 98% limited partnership interest and 2% master partnership interest. So as long as I hold the master partnership interest, I control everything. So this is something we do usually with people worth at least 25 million and up. And sometimes we do this for discounting purposes. So if someone dies worth $50 million, the estate says to the government, hey, we've got closely held S Corp stock, non-voting in our estate. We want a 30 or 40% discount on that. So we're trying to actually reduce the value of the estate. But an interesting thing, and I find that when the clients I'm dealing with are under 50, it's almost impossible for them to even think about what's going to happen in the future and give up any control. But as people start getting to their 60s and 70s, especially if they see other people, their friends going through the same issues, then maybe they're a little bit more open to making some gifts.
So Howard, I think we're going to run up against a break in a second, but just to plant the seed, a point that you made, a lot of times people look at themselves and they're like, oh, you're talking kind of really telephone numbers to me. I'm nowhere near those kind of numbers, but they're young. We could talk about somebody in their 40s or even somebody in their 50s. And when you look at life expectancy today, somebody who has a net worth of $3 or $4 or $5 million today can get to those kind of really high-end numbers 10 and 20 and 30 years down the road. And you also mentioned that these limits are going to change. So the importance of starting early to have these conversations. Maybe you want to spend a minute on that?
Sure. So to me, estate planning is sort of building a house, and you always want to start with the foundation. You could lay a foundation and leave it there for 10 or 20 years and come back to it. You really can't put a frame up, put windows and leave them there for 20 years. So when I have clients that are under 50, 20s, 30s, 40s, and they're doing very, very well, and we project what their net worth is going to be in the future, I always say to them, let's talk about your foundation. Put something in place. You are young. Insurance is very affordable, and you're healthy. You're never going to be that healthy again. And many times I'll show them the same insurance numbers if they're 10 or 15 or 20 years older. It's eye-opening, because once you're 42, you're never 42 again. And if you're preferred and healthy, you might never be preferred and healthy again. So it's definitely a great thing to mention to younger people who are doing very well today.
Howard, on that note, let's take a break. And when we come back, we're going to talk about some, long-term care and also some solutions for maybe some of those clients that don't quite have $25 million, but, in that sweet spot between maybe $3 and $10 million, and still want to do something to preserve their legacy for their loved ones.
Sounds good.
So we'll be right back.
.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner, Dominick Tavella, and our guest this evening, Howard Jonas, Director of Advanced Sales at Crump Insurance. Howard, let's get into long-term care a little bit. Is there a sweet spot, in your opinion, where someone really needs to consider long-term care, whether it's by age, by assets, or both?
Probably by assets. In my mind, if anyone's worth between 1 million and 10 million, I'm automatically thinking about long-term care. Based upon the exposure, the risk, especially the financial risk. Now, if someone's worth $20 million, there's a very good chance they're just going to pull out their checkbook and hire someone to do everything that's necessary. If someone's worth $100,000, things could be very challenging. But you start getting into that $1, $2, $3, $4, $5 million range, you have significant assets. And if you think about the cost of a nursing home, especially in the Empire State, for a year or so, that's a couple $100,000. That's a big hit. So I always push people to have the conversation. What if? Years ago, I used to sell a lot of term insurance to new families, kids, a mortgage, and I'd ask about their parents. And the first answer was, well, my parents don't need life insurance. No, I know that. If one of your parents passes away and then the other one has a long-term care issue, what's going to happen? Have you had a conversation with your parents? And sometimes you'll hear, well, my mom or my dad will just move in with me. And then you'll get a look on the other spouse's face of, are you sure about that? We haven't really had that conversation yet. And it's a tremendous amount to say, Well, you stay home with 2 or 3 young kids and take care of my parent at the same time. Well, I'm going to go to work. The other thing is the financial issue. So to me, if you've amassed a nice amount of wealth, and it doesn't have to be 30 million, it could be 5 million. Do you want to insure your lifestyle? Do you want to insure your wealth? That's really what long-term care comes down to. Sure, you're transferring the risk, the financial risk, but if you've amassed a wealth of $4 million and something happens, do you want to preserve that wealth? Do you want to say to yourself, I got in my car every day for 32 years. I've built up a really nice nest egg, and I want to make sure if something happens, it goes to my kid, or more importantly, maybe my grandchildren. So the question is, how can I transfer that wealth in the most efficient manner possible? How can I ensure my lifestyle? What can be done? Am I even healthy enough? Should I have this conversation? What do I know? What do I not know? To me, having the conversation is great because there's so many misconceptions out there. Probably the biggest misconception I've seen is that people will say, well, if I get sick ever, don't worry, I have Medicare. And I say, well, Medicare is great if you got to go to the doctor, or you've got the flu or the measles, or maybe you need an operation. But if you need care in your home, Medicare generally doesn't cover. If you have to go into a nursing home, Medicare does not cover. Medicare gives you about 100 days of skilled nursing care, and then you're on your own. And people say, well, what about that thing, Medicaid? Well, you have to qualify for Medicaid. Essentially, you can't really have any assets. A single person can only have about $2,000 to their name. So if you're worth $5 million, Medicare and Medicaid is really not an option. What is an option then?
So Howard, this is an industry, the long-term care industry, where it got a little bit of a black eye, maybe two, depending on your opinion on the subject. The companies came out, and this is 10, 15 years ago. They came out with a lot of product. They thought this space of selling long-term care policies was a way for them to be very profitable. It turned out not to be profitable. For these companies. It turned out that they mispriced and misread the market. And so there are people out there reluctant to go out and buy a long-term care policy because of what's going on in the industry. But there are new things today and new products today that kind of get away from that. Maybe you can bring us up to date.
Sure. Great question. So as you said earlier, different kind of products have been around for a while. Back in the 90s, there was a ton of long-term care standalone policy. What's a standalone long-term care policy? You buy this policy, it provides a benefit for you on a monthly basis. You have an elimination period and your annual premium. However, most of the time, if you paid your premiums until you passed away, nothing happened. No one got anything except the insurance company. And people were going on claim indefinitely. And the insurance companies or their actuaries were saying, we got to figure something out, and they increased rates. Unfortunately, most of the people that saw a rate increase were 75, 80 years old. You really can't get another policy at that point. It's cost prohibitive. In the last several years, you've seen the life insurance industry come out with what's called long-term care riders on a life insurance policy. And I'm a big fan of those because at the end of the day, if you don't utilize that rider, your family's still going to get the tax-free death benefit. But the long-term care rider on a life policy can be anywhere from 2 to 5% of the total death benefit. And you receive that benefit essentially if you can't perform 2 of the 6 ADLs, and it's paid out income tax free. So you don't even pay state tax on it. The government really wants people to utilize these products to cover long-term care expenses.
Howard, just to be clear before you move on, 2% of what? For how long? It's not if you buy $1 million policy, you have access to more than $20,000.
Correct. So it's 2% or 5% for anywhere from 48 to 60 months.
So it's 2% a month for up to 4 to 5 years.
Correct.
Okay.
Correct. Yeah, great question.
If you don't mind me also jumping in and clarifying, so it's really a life insurance policy that somebody buys, correct?
Correct.
But God forbid they need the long-term care, they go into a facility, the insurance company knows they're going to pay out on this amount. Sooner or later, that individual is going to pass away. So the insurance company knows that individual is going to pass away and the death benefit is going to get paid out to the family. The insurance company allows, if you have this rider, allows the family to use that money, almost like a living benefit, to help pay for the care. Am I reading this right?
Exactly. It is a living benefit. As you said earlier, the insurance company will have to pay something out in the future. It's either going to be to a facility, some policies, depending on the type of rider. There's two big riders. One's indemnity, one is reimbursement. Reimbursement is how it sounds. You need care, you qualify, you can receive it in the home, you can receive it in a facility, and you're reimbursed for your expenses. Indemnity, which is my preference, you receive that monthly benefit as long as you qualify for it, and you use the money any way you see fit. Unlike Medicaid, this rider allows you to receive all your care in the home, assuming you can afford the care. You don't have to go into a facility. But to me, the greatest thing is if you own this type of product, this life policy with the LTC rider, if you don't use it, your family's ultimately going to benefit. Whereas the standalone LTC, if you never use it, it's difficult to get all that money back.
And you and Dominic raise a great point, because let's face it, Howard, the insurance companies are obnoxious in qualifying people for long-term care benefits. They just are, right? They make it impossible. I have one of my assistants working on getting a client their long-term care benefits once a month. So it may not be a policy we sell, but they get just so frustrated dealing with these insurance companies and the roadblocks they put up. And to Dominick's point, with these life insurance policies with long-term care rider, I think it's a little easier to get qualified for the benefit if you can't do 2 of the 6 ADLs, because as Dom said, the insurance company knows they're either going to pay it now or pay it 6 to 10 months from now.
Correct. So the underwriting is radically different for a standalone LTC. There's a lot of cognitive ability questions, things like that. You really don't see that with a life policy with the long-term care rider. It's sort of a, I'm going to check the box. And when they're looking at your medical history, if there's nothing outrageous or outstanding, the policy will be issued with the rider. So it's a really unique feature, and one that we sometimes use in estate planning. And you don't have to be worth $25 million. There are some people that are only worth $2 or $3 million, and they see the benefit of a trust, because some people really want to keep their assets in their bloodline. So you could have a married couple worth $3 million and they've got assets, and when they pass away, they want to make sure all their assets are used as an educational fund that could exist in perpetuity, and no future son-in-law or daughter-in-law that could be getting a divorce can ever get their access and their hands on it. And some of these policies, these life policies with LTC riders, you can actually put them in an irrevocable trust, and the insured could still benefit from those policies. So generally, if we're going to use those types of policies in the trust or an ILET, we like the indemnity style rider. So mechanically, how we're looking at it is, there's a policy on me in my irrevocable trust, and my daughters are the beneficiaries of the trust. I have a long-term care event. The owner of the contract, the ILET, is indemnified for the benefit amount each month. The trustee will then make a distribution to my children. My children then, in their infinite generosity, I hope, will help me out with my medical expenses or medical bills, because their thinking should be, well, eventually the death benefit will be paid out to the trust. I'm a beneficiary of the trust, so I'll benefit from the policy. So sometimes you can have your cake and eat it too, to a degree, with these life policies with LTC riders in ILETs.
Hey, Dom, can I just ask Howard one other follow-up
Yeah,
question?
please, Mike.
Howard, Dominic and I frequently run into people with $50,000, $100,000, $200,000 in cash value in a life insurance policy. They no longer need that life insurance policy. So we now can use that cash value, correct, if they qualify, take that cash, get them a new policy, maybe a lower death benefit, but a new policy with a long-term care rider, and basically make a tax-free exchange. And now they very benignly have gotten long-term care coverage where they didn't think it was possible.
That's exactly it. So we run into people that bought a policy years ago. They forgot they had it. They thought it was term. They can have any amount of cash in there. And if they absolutely don't need it, or maybe they think they might need it, we can do it what's called a 1035 exchange. It's part of the Internal Revenue Code. There's no tax, no out-of-pocket cost, and many times we'll tell people to do what's called a single pay. They take, this is $50,000, we dump it in the policy. The policy becomes a modified endowment contract or a MEC. Now, normally, if you buy a life insurance policy for tax-free income down the road, you don't want a MEC. But if you have a MEC and you use the policy only for death benefit purposes or long-term care purposes, everything still comes out income tax-free. So it's the policy review is something that is rarely done. And if the policy is in an ILET, it's almost never done because the trustee isn't thinking, hey, the policy's been in existence 9 or 10, 15 years. Let me see what else is out there in the marketplace. Because things do change. You know, riders come in policies, riders leave, but it's always a good to see idea to see what you have, because as you said, you never know. Plans change, people get older.
Howard, one of the pet peeves I get all the time with the older long-term care contracts is the premiums seem to go up every year. On these new contracts, what can you tell me about the premiums?
Sure, great question. If you buy a life policy with a long-term care rider, most of the time your premium will never go up because you have a set premium on day one that you're going to pay into the contract for. So you don't have to worry about the premium going up. Most of the life policies with long-term care riders are what's called universal contracts, which basically means you can do a short pay. So you can do a single pay, a 5 pay, a 10 pay, a 12 pay. And once you're done paying, that's it. And your rider is in force and in effect for the life of the policy. So it's a great thing. You don't have to worry about if you're 82 years old and your health is not so good, you're not going to get a nasty envelope in the mail saying, by the way, you owe us another $18,000.
Which is another problem that, as Dom said earlier, it may be two black eyes that the long-term care industry, subjects our clients to all the time. Like I said before, it's a little obnoxious.
There's really not much you can do. If you're 79 years old and you have a standalone LTC, you just can't go out and buy a new policy. So if you give up the coverage, you have nothing.
And nothing to show for it.
Yeah, the standalone LTC to me is really tough unless you're a special type of business owner. You have what's called a C corporation. Then there's some very interesting tax advantages to using standalone LTC, but that's somewhat of a rarity.
Howard, I know we're coming up again to a hard break, but I just want to stress to people that are listening or watching the podcast. I know we're throwing around a lot of terminology and we're throwing around a lot of ideas. The key is that whether it's you're protecting your estate, your family from dying, death taxes, or in this case, you're going to live in a facility, you really need to think about it early. You need to plan early, and you need to communicate with your financial advisor these issues that are really at the forefront these days.
To me, it's an absolute home run if you have the what if conversation, because there's so many misconceptions. And unfortunately, most people get their information from their friends, which normally is a good thing, except this type of information. And there's a reason why some people are in the industry and some people are not. And we read about this on a daily basis. And you can obtain all this information for free. I'm always happy to talk to anybody. But it's great to have the what if conversation. What if this happens? What if this happens? Will this cover me? Will this cover me? Will this not cover me? And then at least you make a more informed decision.
Howard, we appreciate you making the time tonight. I know game one of the Rangers is tonight, so you got some pre-gaming to do, but I appreciate you making the time for us this evening. You provide a lot of information.
Absolutely. Glad to be here. Let me know when you'd like me to come back. Happy to join.
Howard, thank you. At the very least, we started a conversation, and hopefully it helps people out to think about longer term issues. Thank you.
Absolutely. Appreciate it.
Thank you, Howard. Dom and I will be right back after a quick break.
.com. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with my partner Dominick for a quick wrap up. Dom, I have to tell you, we're both financial professionals. We own an insurance company at this firm, and one of the most frustrating questions I get is, do you know anything about life insurance?
Well, at least you're getting
And that's
the
my
question,
fault.
right? At least you're getting the question. I would add to the frustration that, look, I appreciate that the issues Howard brought up. Sometimes they can sound complex, and sometimes, we throw out terminology, right? And I don't expect the clients to know what all that stuff means, but just ask us what I call the dumb question, right? Just ask us or tell us what's going on in your life, right? I have a parent that is ill. My spouse is having some issues. The value of my estate. How do I get these assets to my children? Because the start of that conversation allows you, more than me in this case, but the experts to come in the room, and we can invite an expert like Howard in, or we've had our friend Harold Balacha, the estate tax attorney. We can invite the experts into the room to go, hey, let's have an adult conversation. Let's do some planning. Maybe we'll never need it, but if we do the planning today, it'll take care of us tomorrow.
Exactly. And even the simple, I bought this policy 15 years ago. What should I do with it? They look at it frequently as a dead asset, or they was sold. It's something they could borrow against, and they didn't need to do that. So just as you said, just asking those questions, doing the reviews, and I know that whenever we go do a review at someone's house, we ask them to show us everything, but frequently they leave that part out, and that's still our fault, right? That we have not been persistent in asking to see those policies.
Yeah, and have them reviewed, right? And we get that one all the time. I have this thing, they blow the dust off of it, right, Mike? And they go, I bought this in 1973, and it's useless. It doesn't serve a purpose. No, it's a brick in the wall that we can use now. You bought it for a purpose 20 years ago. That purpose is long gone today, but now we can repurpose it to solve another problem, right?
Exactly.
And that's an excellent idea. Both Howard and yourself brought up. I thought that was a terrific suggestion.
Thank you. So look, a busy night. I mentioned it to Howard. We got a Knick playoff game, a Ranger playoff game. The Mets and the Yankees are playing. It's not that often we have, and by the way, all 5 professional hockey and basketball teams made the playoffs this year. I don't think that's ever happened before.
I don't remember when. So we'll have a little bit of a busy night, hopefully a positive, entertaining night. And we'll pick this right up a week from now, Mike.
Yep, we'll be back with our podcast next week. And have a good night, everybody.
Everybody be safe.